Markets in the U.S. rose today, even though the Supreme Court struck down Donald Trump's signature IEEPA tariff policy. So for more, let's welcome Matt Orton, Chief Market Strategist at Raymond James Investment Management. It's good to have you join us. Thanks so much.
Great to join, Lindsay.
Okay, so we're watching markets react today in the green even after the Supreme Court ruling. Is that the reaction you would have expected?
So I'm not surprised that the markets rallied. This was largely expected, so it's not really a surprise to anybody that the tariffs were struck down. I think there's an expectation, or perhaps the knee-jerk reaction is that we have a little bit more clarity with respect to what tariffs could look like in the future. And while that's true to a certain extent that these IEEPA tariffs can't be imposed any time that the executive wants them to, tariffs are not going away. And if anything, we're going to have to now sift through implementing tariffs through other sections under the U.S. Trade Code. So a lot of these tariffs I fully expect to be implemented in other ways, and many of which through this 10% global tariff that's being implemented. And then further down the road, once we can get to Section 233 or 232 or 301, I think that's going to be determined, and perhaps still more uncertainty for the overall market. But I think the market's rallying because fundamentals are good, and just another catalyst is now out of the way.
So some uncertainty still, but as you say, maybe some certainty. Maybe it's still too early to tell, but would this affect how you would position your investments going forward?
So it largely doesn't, because a lot of the investments that we've been focused on are rooted in the overall fundamentals. It's rooted in the idea that I would argue, despite the softer than expected GDP print this morning, that the underlying economics supporting the U.S. economy are very, very strong. We've got a sticky inflation environment, but one that doesn't look like it's moving higher. It's staying fairly consistent, and over the long term, we expect it to start to soften a little bit. Tariffs might help that in the short term, but earnings growth is strong. There's opportunities being created in technology, especially as a lot of parts of software are taken out without really looking at the overall fundamentals. Industrials continue to remain incredibly strong. Energy markets remain supported, and earnings look like they're inflecting higher. So a lot of those have been our favorite sectors so far this year, and that remains the case right now, irrespective of what's happened with tariffs.
Okay, now you mentioned the fourth quarter GDP results that came out today. So I want to ask you a little more about that, because it was significantly below estimates. Is that a one-off, do you think? Is that because of the U.S. government shutdown that we saw in the fall, or is that something else?
Yeah, Lindsay, that's exactly it. I think it's that latter piece. The U.S. government shutdown materially took away from the overall GDP print. So if you look through that, a lot of the investment consumption, those numbers remained relatively strong and fairly consistent with the past prints that we've seen. So I think we can look through some of that weakness. The one thing to home in on, though, is that the inflation that's implemented in that GDP report, that was higher than expected. And so I think we have to now grapple with the fact that the market might be a little ahead of itself with respect to Federal Reserve cuts. And so I would look at that as a potential catalyst, maybe for some more volatility in the near term, especially as we head to March and get updated economic projections from the Fed. But my main message to clients, Lindsay, is that if we do have any volatility around inflation, around what happens with the Fed, investors should lean into that volatility, because the underlying fundamentals still remain very, very strong. And I would be a buyer of any significant dips in this market.
Is that what you mean by leaning into that volatility, is buying on the downside?
That's exactly it. And you want to be selective again. Industrials, some more cyclical parts of the market, energy, those are our favorite areas to look at, as well as the AI CapEx beneficiaries on the technology side that may have been thrown out with the bathwater, as we've had a lot of these rolling sell-offs as a result of AI fears.
Yes, you mentioned the AI spending. I wanted to ask about that. I'm wondering, there's predictions this year that 2026 will actually be another resilient year for the U.S. economy. Do you think that that increased aggressive kind of AI spending we're seeing is offsetting some weaknesses in other sectors?
It's certainly contributing to very, very strong growth. I think we're actually seeing a little bit of a pickup with respect to CapEx coming from other non-AI related sectors in the economy. That gives me even more confidence that the cyclical recovery we're starting to see that's benefiting industrial companies is likely to be durable and in place over the longer term. So I think that the AI CapEx can continue to benefit not only a number of technology names downstream, but also more of the cyclical parts of the economy, such as machinery, such as trucking, other areas that are going to be needed to build out data centers, build out some of the power capacity that we need. So I think it benefits all parts of the overall economy.
We've got Nvidia scheduled to report earnings next week. I know you can't talk about specific stocks, specific companies, but just overall, do you believe like a strong quarter from a company like Nvidia could ease some concerns of investors in terms of where this sector's going?
I absolutely do. I think nothing would be better than Jensen coming out and having very, very strong numbers, but also projecting strength with respect to their benefit from a lot of the AI CapEx that's taking place and how that's impacting a lot of the companies that they partner with across the overall supply chain. That might help to allay some of the fears about what AI is doing to other parts of the market. And that sort of strength, I think, might help stabilize information technology. And that's why that's an area where I'm actively looking to buy some of the dips that we've seen, because I think there's a lot of good, high quality names that have just been thrown out with the bathwater. Investors can find good opportunities, especially in those where CapEx dollars are actively being spent.
Absolutely. Okay, we will leave it there. Matt Orton, Chief Market Strategist at Raymond James Investment Management. Good to have you today. Thanks so much for joining us.
Thank you.